Y'all got to check this out. This is absolutely fascinating to me. I'm Eric Garcia, certified financial planner and financial advisor, and I love reading the financial headlines to see what's going on in the economy, to see what's going on in the world, and just compare that to how the stock market reacts because it just proves this point, kind of dispels this myth that the economy and the stock market are proxies for each other. On the contrary, we don't see necessarily the stock market and the economy perfectly correlated. Sometimes they work in opposite directions, as we are seeing now. In a previous video, I talked about the stock market being a leading indicator for the economy, meaning the stock market typically leads the economy. So if the economy is on the way to get worse, it means that the stock market already had its bad times behind it. The stock market will tend to lead the economy out of bad times. So we start to see the stock market recover before the economy. So check this out. So we had the job numbers come out officially today, but they've been trickling out for some time now. So if you're just the average news watcher, you're just starting to see this bad news, right? Historic numbers. U.S. economy loses 20.5 million jobs in April. Unemployment rate soars to a post-war high of 14.7%. These are staggering, concerning numbers. Obviously, due to the shutdowns, a lot of businesses are closing or furloughing or firing employees, letting them off. But even though we have this terrible, terrible, terrible news about unemployment, the stock market today, now it's still early, it's 8:52 Central Time, on May 8th. The stock market is the Dow Jones is already up 1.3, the S&P is up 1.1. I mean, if these numbers hold, these are good returns, really good returns for the day in light of this terrible news. Here's something to keep in mind. Again, if you're the average news watcher, this news is not a surprise to economists. It's not a surprise to seasoned investors. This has been predicted literally for months now. We knew that the first quarter numbers were going to be bad. We knew that April was going to be bad, and we know that the second quarter, May, June, and July. Let me back up. The second quarter, April, June, and July. We know that that quarter is going to be worse than the first quarter. So the economic news is going to continue to be bad. It's going to continue to be scary. This is why, to be an investor, you have to have some emotional fortitude, right? This is why it's a good idea to work with an advisor who can keep you to an investment plan, who can keep you focused on the long term. Remember, the stock market will reward those who stay invested. Now, here's another kind of myth or misunderstanding that I want to dispel really quick is that people think to be in the market, you got to be exposed to tons and tons of volatility. That's not necessarily true. Investment portfolios can be designed to manage out some of the stock market volatility. But the stock market is a good place to grow wealth over time. Over time is key. It's not a place to make money overnight. Certainly, you can lose value, but over time, the stock market has always rewarded those who stay invested. So, as the bad news comes out, don't let it knock you off your long-term financial plan. Don't let it knock you off your long-term investment plan. If you don't work with an advisor, working with an advisor is a really good idea. It's a really good way to keep you focused on your plan. Thanks for watching. Y'all take care.